Okay. Hello. Welcome to my first video. Tried to make this 3 times in a row. It's not gone so great. But honestly, that's how I know this one's going to go perfectly. Okay. So if you clicked on this video looking for more trading strategies or the best trading strategy, um, you're either probably not going to get that or going to have to wait. Because what I'm going to be talking about is the overall logical system that moves a majority of the money. And we're not really going to be talking about how to utilize that right now. We're going to be talking that in a future video. But today we're just going to give a brief introduction to portfolio management. What portfolio management is large institutions which have a good bulk of assets, which you can view as money in the pot of futures, stocks, options, you name it. They have assets in their collection. Um, these portfolios, or sorry, these asset managers are constantly looking to, in stable conditions, increase their exposure, which is a, have more assets in their collection, and always minimize their risk. And sometimes minimizing their risk includes lowering their exposure and getting rid of some assets. Um, Most of the time, though, it simply means diversifying their assets and um, trying to either roll over their positions or um, in some way passively manage their risk. And one of the early concepts I want to talk about is what is known as the CAPM model, the capital asset pricing model. Well, I said CAPM. I'm actually an idiot. Okay. Now, which you don't really need to understand this model unless you want to be an algo trader, and to some degree, this model actually is more of a theory than a model, and you can't even really utilize it. That is because someone in the comments can correct me if I'm wrong, but I'm fairly certain that the CAPM um, has the assumption that all assets are managed passively, which is not the case. So you can utilize this to a degree, um, and you can probably even get pretty close if you have enough stock beta or if you have a good enough system for computing uh, sectionality beta. Like if you can compute tech sector versus defense versus healthcare, like you can use this to a degree to understand like sectional risk or stock based risk. I guess if you have a pretty big system, that's probably a little more difficult though for how you actually compute risk. But basically, the CAPM was a model used to compute measures of risk. The only reason why I'm bringing the CAPM up is because the CAPM made it clear that the best portfolio to have is a passively managed census portfolio. What that means is the average portfolio, the census portfolio of all asset managers, is the least risky and likely the most exposed portfolio at any time in the best way. So, because the uh, the attempt at strategy outside of the census implies some existence of a greater idiot, a greater fool. If you actively manage your assets instead of following the market census, what you're doing is expecting someone to be stupider than you. And in all of the wealth and genius of Wall Street and every bank and economics in the world, the smart person understands the census is probably more accurate than any whim they have, which is why a lot of institutions look to manage passively. However, the reason why I say passive management is likely impossible is to some degree it is doable. Different management systems have different levels of exposure and access to different levels of capital. All right. For example, right, a tiny bank with 200 million versus some hedge fund worth, $1 trillion. Well, the $1 trillion hedge fund has much more massive positions to consistently roll over. And arguably, that bank, which only has 200 million, it might have access to less information and worse models, and therefore might perform worse, but it arguably has an easier access to participate because it does not have to, it gets to manage a lower position. It does not have to manage a higher position. It has less risk due to its lowered exposure versus billions of dollars, which constantly has to be exposed. They need greater access to liquidity and greater volume to keep their risk lower or keep their risk as low, which is less likely. So they are the loser there. They cannot manage as passively because their positions have to be more active in order to be successful. And that is a system that we can use um, within trading. What I'm going to be talking about the rest of this video is I just wanted to give a brief introduction to CAPM, passive management, and quickly cite that active management, anyone who manages actively, either has to or is doing so with the understanding of or with the hope of a greater fool. They're hoping that someone takes the opposite position and is like more stupid than they are, which in the world of geniuses is not a smart thing to do. Unless, and this is what I'll go into briefly, unless, and this is when you see, which I'll also could talk about in a second, the intraday cycle. When you see this intraday liquidity cycle break in, and unless for active position making is informed trading, right? If an institution or a firm has access to information that will greatly impact the economy, they have the upper hand and do not need the existence of a greater fool because they beat out the census portfolio. But that is only when they are informed and get to jump and etc. Retail trading has no real implication on the overall money of high frequency trading and portfolio management. It is just a drop in the bucket unless it is, recessionary or incredibly heavy news. But by that time, the funds have already acted as well and understand that interpretation, and there is still no real impact that people have on their decision making. Um, get rid of that as well. So next to what to go into is the intraday liquidity cycle. What that is different phases of a typical cycle that institutions use to manage risk due to typical volume profiles of sessions. What I mean is during Asia Open from 8 p.m. to I believe 9:30 p.m. what you have is pretty low volume and pretty low typically volatility. What institutions would do here is look to manage their efficiency and their exposure on a low scale. So they're not looking to fill, 10,000 orders or 100 orders. They're looking to maybe just diversify, or sorry, they diversify with 100 instead of, 10,000 or 100,000 or 1,000. Um, and they can be more easily filled with much smaller pools. But sometimes, and this is also what I'll go into in microstructure, but Asia can act as a liquidity supplier, where a high is being set with um, some level of fillable orders uh, to one side, or a low is being set with some level of fillable orders that can then be acted upon in post Asia or late Asia after Asia lunch. And that I would surmise, although I'm not the greatest Asia trader, is where you see. Well, sip of the water. Um, that is where you probably see some positions actually manage. However, they have much less access to assets than the United States, and and because of that, I would imagine also that their positions are not managed to a crazy extent here. The next session, with a little more volatility and volume, is London. I'm pretty sure, and I could be incorrect, but I am pretty sure from some of what I read that London financial system for their asset management is a little less up to date on their algo trading, and because of that, their price action is a little bit more patternized. And one of the reasons for that is their management is a little less instant at measuring certain levels of efficiency for their portfolios. And because of that, it's a little more patternized. That's just kind of what I've heard and read. I could be falsely wrong about that. But what I do know about London is the important thing from London is phase three of, or the intraday cycle phase three, which is late London from around 5 a.m. to 8 a.m. That session high or low is set. And that session low or high acts as the big point that is used for typically New York Open management. Now, if you're saying, well, this kind of just sounds like a system, this kind of just sounds like a strategy I can use. Here's where I'll burst your bubble. This works sometimes. It works in stable markets. It probably worked in September and November. However, it does not work for the following reasons. One, because risk can be managed at any time. But more importantly, risk has to be managed when traders are informed. When news is released, and what you've been seeing over the past year with Donald Trump, of these random like 10 p.m. decisions of like weird policy, is you're seeing these crazy Asia moves or these weird London moves, and then this lull in New York. And people are taking these positions and kind of just getting lucky on the aftermath or the liquidity supply of the post move. What I'm seeing on TikTok, and I'm confused, is there's no reason you should be trading now. It's impossible to, because these institutions are being formed of these massive risk decisions before retail can, and they're acting on it outside of a typical liquidity cycle because they have to manage their risk from such a macro decision. And then the efficiency balancing and the reset of the cycle in the following day is being utilized by idiots as some form of like ICT fundamentals. There's there's nothing there. There's almost no, like, maybe some of these ICT traders have a regression algo to compute risk metrics, and for some reason they are so talented actually at trading that even when when this policy decisions happen and this information trading has happened, that they just understand that they're just that good. I'd argue though they're not. I'd argue though they're not. And I'll get into the microstructure system of how high frequency trading moves and how to actually trade with the system in the coming future. But for now, what I want to say is if you are trading under the assumption that inefficiencies in the market are set by visualized blocks on a certain time frame chart, you're you're a ridiculous human being. You are an interesting individual because you are somehow under the assumption that institutions care at all, that the actual 90% of the money cares. And the reason that really pissed me off when I was trying to learn all this is I was looking at ICT and his concepts and what he was showing. I was like, what is he seeing? What is he seeing? And his model is constantly updated, but all that he is seeing is visualized liquidity delivery. He rarely talks about the supply, and liquidity supply and demand is not even half of the full picture because that has nothing to do with portfolio management, which we've talked about today. And if you're saying now, well, you didn't actually see how institutions manage their portfolio, you didn't actually see the passive system. You're right. But I really don't actually have to, because there are risk metrics that you can utilize. They're just a little bit harder to illustrate than a box on your chart. I don't know. I think that's all I'm gonna do today. The first video. First video. We'll let it be. We'll talk about the other stuff later. The other issue later. And if you want to know why I believe that the that stocks tanked today, some people might believe it's the fucking Epstein files. Um, I think it's because of the Russia dollar news, and the dollar got strengthened, so assets were moved out of uh, stocks and metals back into the dollar because the dollar got stability and strength, which is why everything fell. That's just my theory, but there could be, there's probably a fucking an order block right here, right here, right. There is one. What? Right? Look, look it, look it. Yeah. Okay. I'm done for the day. I'm being an annoying guy. All right. Go have fun.